Welcome, everyone. Thank you very much for joining us again today. I'm super excited to be talking about the fundamentals of investing with a good buddy of mine, friend, colleague, Tyler Doyle from Invesco. It's been crazy. We've been doing this type of bi-weekly webinar for a very long time, and on our YouTube channel we have 18 videos already posted. There's probably about another 5 that weren't posted because of compliance issues, and there's a couple more that are in the queue. So we're really happy you guys are coming to our YouTube channel. But let's start with Tyler here. I'm going to let him introduce himself.
Sounds good. Thanks, Sheean. Nice to be here. Yeah, a little bit about myself. I've worked in the financial industry for probably about 20 years in a variety of roles, whether it be client service, equity research at a major bank, sales, product development, management, and more recently working more as a consultant, working alongside financial advisors in the industry to help them work on business building and also implement product positioning ideas. The firm I work for is Invesco. We're a global independent asset manager. We've been entrusted to manage about $1.4 trillion in assets. We don't have any banking operations, insurance. Our sole focus is on money management is essentially what we do. So we provide products through exchange traded funds, mutual funds, alternative investments, as well as separately managed accounts. So that's a little bit about myself and the firm.
And how much money you guys manage, you said?
It's grown. It's 1.4 trillion in assets. So
wow,
we would be
that's
one
a lot
of the
money.
It is. Yeah, so, and it's on a global basis. So we've got operations, I think, in over 29 major cities around the world. And what we pride ourselves on is providing global perspective and that pure focus on investment management.
Oh, that's great. So why don't we just jump right into it? I think everyone can hear me okay. Yep. Okay, good. So let's start with the investing fundamentals. I believe there are 4. So why don't you tell me about them?
Yeah, things can seem so complicated sometimes, but when you really try and simplify it, it comes down to a handful of things. And you mentioned 4, so it's all about starting early. The more money you can set aside earlier, the more and the longer time it has to grow itself. Investing regularly is important as well, ensuring you're well diversified, and then ignoring the noise and thinking long term. So we could, if you want, dive into each of these a little bit further.
Yeah, let's just talk about starting early. I mean, a lot of people have, some savings. They could be children or whatnot, and the savings sitting in a bank account at a very young age. Like, when should we start?
As early as possible, even just to try to teach your kids the value of money and the importance of putting some of that aside, they can start to see the impact of it growing over the years. But even as you get older and enter the workforce, is you're 25, the difference between putting money away when you're 25 and starting at 35, that can make a huge impact upon your retirement. So, it's just allowing that money to work harder and longer for you. So setting it aside, the earlier the better. And if the parents can help those kids and instill those values of savings, huge benefit to the family over a long period of time.
Yeah, I think it's really important to even let our viewers know. I mean, I work with my father now. I started investing when I was like 15 years old, and I've certainly reaped the benefits. So that's what I teach my clients as well. Let's talk about investment regularity, like when or regularly. What's the frequency people should do this?
For sure. With technology and automation, it's really come a long way in the sense you can set up for pre-authorized contributions. So you can dovetail it and line it up with your pay periods. It's similar to paying a mortgage. You could have it come out more frequently. So by having that kind of set up as a fixed, and I would almost call it a fixed expense, and changing your mindset that savings shouldn't be what's left over and what you don't spend, it should be no different than your food bill, your rent or mortgage. Kind of thinking about it as a fixed expense goes a long way. And that's something I learned from my grandfather over the years, is that it's not what's left over. You have to account for it with the cash flow that you have. So doing it regularly, and then if you have a lump sum at the end of the year, throwing that into your registered savings plans or TFSA or whatever account makes the most sense for you is really important as well.
Pay yourself first.
Bingo.
Diversification and then long term. So let's talk about diversification.
For sure. So diversification is probably the easiest way to increase your potential returns over the long term and decrease the risk of loss. So by being less exposed to one individual area of the market, you're able to ride and have a smoother risk and return profile over a longer period of time. And you tend to have exposure to all areas of the market. So you're not just waiting for that one part of the market to go up or exposed to the one part of the market that goes down. And you mentioned long term as well. So really trying to ignore the noise. If you listen to the news every day or the media, there's no shortage of bad news and bad headlines that are out there. Yet over the years, people have made tremendous amounts of money off the stock market and investments. So by having a plan, working with an advisor, ensuring you stick to the basics of investing, ignoring those ups and downs, we know that there's going to be bull markets and bear markets, good days and bad days. But what really is going to drive your success over the long term is treating savings as an expense, putting money away, doing it early, and doing as much as possible. You have the ability to control how your retirement and your wealth turns out, rather than relying upon the ups and downs of the market. We know that they go up over a long period of time.
Yeah, if you look at the long-term growth rate of the market, it's like it constantly, like even a chart, it constantly kind of goes up and up and up. I know it goes like this, but yeah, if you work with an advisor, you can figure out how much to put in different markets so that you can have that kind of straight line of growth, right?
Exactly. Try and smooth it out as much as possible.
Yeah. So why don't we talk about another subject here? It's called compound growth. A lot of people may have heard this term before, but don't actually understand it, or maybe they do understand it. So let's just go over that.
Sure. So compound growth is pretty simple. It's almost, you think about it, it's money's best friend. So by having time behind you, you're able to have that money grow year over year, and the growth in itself grows on top of the initial principal, as they call it. Think of it more straightforward as an analogy. If you were standing on the top of a hill and you packed a snowball, you set it in the ground, and there's enough steepness in the hill, and it starts building momentum and growing and going faster and faster and faster. That's similar to what your wealth can do, but in the opposite side, it's going in that upward direction and compounding and growing and getting bigger and bigger over time. So that's the key thing, is setting yourself up and growing alongside some world-class, really good businesses for a long period of time, or having a well-diversified portfolio will all help contribute to that compounding effect.
Yeah, that snowball is going to be quite large by the time you get to the bottom. I'll tell you that much.
Bingo.
There's also like this rule of 72 thing that maybe people have talked about or heard about. You want to explain about that? Explain that?
Sure. So it basically, if you divide 72 by the interest rate or the rate of return, you get an answer on how quickly things will double. So for example, if you invest $10,000 and you get a 10% rate of return, in 7.2 years, your money will double and you end up with $20,000. So the rule of 72 is a really good way to start thinking through what is maybe a hopeful rate of return and how quickly can that money start to double for you. And then you can really start to see the power of compounding. And like we talked about earlier, if you can start doing it earlier in life, it becomes that much more powerful. You've got a longer runway for growth.
Yeah, I like the rule of 72. It's a good way to figure out when you should expect your money to double, especially if you're not investing regularly. But that's going to bring me into my next point here. So a lot of people talk about timing markets. I mean, in the middle of this COVID pandemic, I'm not really sure how many people took a bunch of savings and dumped it at the bottom into the market, but those that did made a lot of money. So instead of trying to time the market, well, what's subsequent investing like? What would be the best way to go about that, you think?
Sure. A lot of times, I remember the old infomercial. It was like, set it and forget it. And that's kind of like investing. Sometimes you can do the pre-authorized contributions where you're setting those up in advance, and every pay period or on a monthly basis, out of your account, it's automatically taken out. The benefit of that is through market ups and downs, you're buying at lower prices when the market goes down, you're averaging up when things go up as well. But it's able to kind of smooth out the impact of one individual lump sum investment. We'd love to say that everybody has the mental fortitude to basically invest when the markets go down, or the hindsight to know when the market's at a peak and about to roll over. But the reality is nobody has that type of 20/20 vision. It's only in hindsight that you're able to see that. So by having these regular contributions, it's a lot more powerful, and you can start to kind of sleep more comfortable and almost forget it. And you just see over time your wealth is growing.
Yeah, I think it's really important to kind of also talk about that point of doing consistently. I mean, if you were one of those people that had an automatic contribution through the COVID pandemic, you actually were investing without even knowing at the bottom of the market. So you actually reaped the biggest benefit. And we know that something like this is going to happen again, right? So, I mean, what great advice. That's great.
For sure. And then if you've got money left over at the end of a year, you can make a lump sum contribution in January of the next year into a TFSA, or before the end of the RRSP season into your registered saving plan, depending what makes more sense. So set up a contribution as much as you can that's pre-authorized. And then from there, if there's leftovers, still don't be afraid to make a lump sum on top of that, because there's tax advantages in some cases as well.
We are going to come back to that question, RSP versus TFSA, at the end, but let's just keep going through the way I've kind of laid out all these questions for you.
Sure.
Let's talk a little bit more about diversification. I know people are now talking about cryptocurrencies and bonds and ETFs and mutual funds, segregated funds. What the hell is diversification? Pardon my French.
No problem. So really, it's investing in different types of investments spread across geographic regions, structure of investments, asset classes, sectors, and size of investments. You know, you want broad exposure to reduce risk and give you more peace of mind. I always think of diversification almost from an analogy standpoint, and there's two really good ones that come to mind. One is, you know, if you had a choice to go up an elevator and you're going up an elevator in a 40-story building, one is supported by one cable, one is supported by 4 cables. I'd much rather choose the one that's supported by 4 cables, because if anything ever went wrong and you're in an elevator with only 1 cable, you've got a major problem. If you're in an elevator with 4 cables, hopefully you're able to get up or down with those 3 cables. So there's redundancy, backup, and you're less impacted by one event that could hurt you as well. Another analogy, Sheean, knowing that you're a golfer, you know, if you've got a beautiful house 230 yards down on the right-hand side of a par 5, and you get a weekend warrior out and he's hitting and he slices the ball, and that thing goes through your big, beautiful bay window. What a lot of people have started to do to minimize the risk is they break that huge window into maybe 9 or 12 individual smaller panes. You may be giving up a little bit of your view, but the impact of that ball going through an individual pane is that it's a smaller piece of glass to replace. It's less risk. It's less of a problem or a challenge when something bad happens. That's very much like investing in the markets, ensuring that you've got different asset classes, different investments, things that zig and zag at different periods of time help to smooth out that return profile and help you sleep well at night.
And if anyone has ever seen Tyler play golf, if you have bulletproof windows, you better put them in, because he will hit your window on that par 5.
Exactly.
Okay, so let's talk about like the different markets where you can kind of invest. Like, where do people invest? I know, you know, a lot of people walk into a bank branch and they'll say, I want to invest money, or some people will see a commercial on TV and it's like, there's a lot of different commercials out there now. It's like, yep, put your money with us, cheaper, whatever. Why don't you talk a little bit about that?
For sure. There's lots of options. There's some that are very short-term in nature and very secure and guaranteed. These are things like money market and guaranteed investment, GICs. Often these carry very little or no risk, but don't offer that significant rates of returns, especially when interest rates are low. There's also equity investing, and that's on stock markets around the world. What we find in a lot of cases is people here in Canada very much have a home country bias. So a lot of their investments are in Canadian banks and Canadian insurance companies, but there's a whole world beyond there. And Canada just represents a very small portion. So there's stock exchanges in the US, there's in Europe, emerging markets as well. You also have the ability to choose more diversified products like an exchange traded fund or a mutual fund that will lump and pool a lot of investments in it as well. And then there's the opposite side of equity investing, and that's fixed income investing. So you could be a bond or fixed income investor and hold government debt or corporate debt, investment grade, or becoming a little bit riskier and getting into high yield debt as well. So there's a lot of choices out there, and figuring out the right ingredients and the right mix to build a diversified portfolio comes with an advisor having a good understanding of what's important in the goals of the client ultimately.
Yeah, I mean, ultimately, it all comes down to your personal financial plan. You know, you build this plan up, you figure out your savings, and then you figure out, once you have that like roadmap to like, you know, how to get from here to Florida, you follow the roadmap and we figure out which ingredients that we need to put into the portfolio so that we can get there. It's a super important thing. A lot of people don't do it, but I think it's important that we touched on that.
That's great.
So let's move on to the next piece. And I know there's a lot of people right now talking about this thing called inflation. And I mean, we all see it. Go to the Home Depot or Lowe's or whatever company, and you see the price of lumber's gone from, you know, $2 for a 2x4 all the way up to $11, $12 for that 2x4. You gone to the gas station, it was 67 cents for the price of a liter of gas, and now it's $1.20 or 30. And I mean, if you have premium gas, it's $1.50. If grocery store, you go to the grocery store, you pay for broccoli, 1 week was $1, the next week it's $3. This is something called inflation. Let's talk about that, and why should people be aware of inflation when it comes to their investing?
For sure. And it is something we haven't had to worry about for a period of time because we've been in more of a deflationary environment. And now we're starting to see, after COVID, the economy starting to function. There's been issues with supply chains and different things. But inflation, in the simplest terms, is it's your money becoming worth less over time because things get more expensive. So ensuring that you've got a portfolio to offset this more expensive cost, you need to make sure you have adequate savings and that your investments grow over time, to ensure that you can factor in an inflation rate in your projections for your financial plan, so that when people retire, they've accounted for not only the growth they need, but also the inflation that erodes their purchasing power over time.
Yeah, I guess the real killer is inflation, because no matter what, if you're not investing your money, you're keeping it under your bed, you're actually losing purchasing power as you get older.
Exactly. So we've seen things double or triple over a period of 20 or 30 years. But what's really interesting right now is we're seeing fairly short-term, significant jumps in certain prices. The question is, do these stick around, or is it more short-lived and things start to normalize? We don't know those answers, but it's important from a planning perspective to make sure you account for them on a long-term average and factor in some element of inflation into the projections that you're making for clients.
Let's just talk about one more thing. For inflation, what is like the typical growth rate of inflation?
So often people would look at like a 2 to 3% rate of inflation. That is what the central banks often target. Now, we've been below those for quite a period of time. Now we may start to run what they call a little hot. So it may run a little bit higher. And if inflation gets too high, they start to raise interest rate. And that's kind of a form of tapping the brakes on the economy. So long-term average, I would say, is anywhere between 2 to 4% is what a lot of people would factor into modeling.
So if you're keeping your money in your bank account, you're earning 0% interest, you're telling me a $1 after 1 year is worth 96 cents?
It does go down in value in an inflationary environment. That's right. So that's why you want to make sure that you're balancing risk and return and factoring in the fact that, the value of money goes down over time.
Yeah, that is, I think the real killer is definitely inflation. Wow. Yeah. Okay, I know we've actually gone through a lot of questions already. I haven't seen any questions come in on the Q&A. There is a little button right there. If you click on it, you can actually type a question in if you'd like. But I think a lot of people want to talk about this section. And it's the RRSP versus TFSA section. That is like one of the biggest questions a lot of people have. Why don't we talk about that? I'm sure you can't do it in one sentence. So let's start with however you want to start it.
Sure. Maybe we'll talk about the registered savings plan, or the RRSP, first. And this is basically a retirement account that's been in existence, I think, all the way back since 1957. So it's got a long history. A lot of Canadians are very familiar with it, and they've contributed to it over the years. As the name suggests, it's designed to induce people to save for their retirement. It also provides additional benefits like deferring taxes so that your current year's tax bill will be brought down. So simple terms is that if you contribute $10,000 to your registered savings plan, that helps to reduce your income by $10,000 in that year. And on top of that, you have tax deferred compounding of growth. So meaning that until you start to pull money out of that plan, you are not paying any taxes on the underlying investments. They continue to grow shelter, and year over year, like we talked about with compounding and growth, they start to balloon and grow until ultimately you start to take those investments out, and they're treated as income when you start to redeem them.
Is that similar to pension plans, CPP, old age security? Those work the same way? Do you pay taxes on that money?
There are similarities in those plans, for sure. And it really comes down to balancing all of the different plans that people have exposure to. So that's where working with the financial advisor, understanding the cash flow and the income that will be coming out upon retirement from all of the plans, including the registered savings plan and the tax-free savings account, will help to forecast the cash flows and ensuring you kind of optimize the overall mix of investments.
And then what about the TFSA? You did talk about that. I think this is like the secret weapon or the smoking gun in Canada right now. Everyone loves TFSAs. Why don't we talk about that?
For sure. So they're a lot newer, the TFSAs, and they could be used and have different applications, but basically it allows for tax-free gains. So the amount of money that can be contributed to the tax-free savings account, it does change. The Canadian government introduced these in 2009 to help people save money. Often what people have done, if they've maxed out their registered savings plan, they then start to put money in the tax-free savings plan. But depending on the situation and working with a financial advisor, that's where you can start to get into more advanced planning strategies, because there are other uses. And in some situations, the TFSA may have more value over the RSP. It just depends on the unique situation of the investor.
Yes, we couldn't agree with you more. I think that the tax-free savings account is a wonderful tool. You can invest I think it was actually poorly named too. It should have been called the tax-free investment account instead of the tax-free savings account. I couldn't tell you how many people have a tax-free savings account that's sitting in cash and they're not taking advantage of that tax-free growth.
Exactly. And I was going to mention that with, a lot of people seeing the name savings in the title, they think that you need to have a savings account or a low interest rate type of generating investment, but you can put more growth oriented investments depending on your risk tolerance. These things can be compounding machines sometimes and could complement maybe a more conservative registered savings plan. So a lot of choices and a lot of ingredients that can go into the RSP from an investment choice perspective can also go into the TFSA.
So you did bring up one thing. Let's talk about contributions. Sorry, not contributions. Let's talk about when you put money into a tax-free savings account, how does that affect your taxes? Because you talked about it in the RSP, where if you put in 10 grand, it reduces your income by 10 grand. So what happens to that TFSA?
So TFSAs are paid with after-tax dollars. So that is the key difference between the registered savings plan. You're not going to get a tax refund from the government, and it doesn't lower your income. The benefit of the TFSA is you get that tax deferred compounding similar you do to a registered savings plan. But when you take the money out of the TFSA, it's treated as capital gains and not as income. So the way at which the money is taken out, the taxation is done differently.
Yeah, when you take the money out of a tax-free savings account, it's tax-free. Whereas the RSP, your deferred taxes over time is now getting paid, right? So I think that's a great point there. Now let's just talk about another thing about RSP versus TFSA, and then I'm gonna say, let's talk about two different scenarios of two different people and when they should use either. We may or may not know the answer right here live, but if we make a financial plan, we can figure it out. So let's talk about contributions. So putting money into an RSP, how much can you do it? And then versus like a tax-free savings account, how is it calculated?
For sure. So RSPs are done as a percentage of your income, and that has changed over the years. So you would probably have a better idea off the top of your head what the percentages are currently, but that's changed where the TFSAs are more of a set amount prescribed by the government. So the RSPs dependent on your income level, and the TFSAs are not dependent on your income level.
Yeah, no, like Tyler said there, I do actually know the number. It's 18% of your income up to a maximum allows you to put into your RSP. The maximum amount contribution room, I can't tell you off the top of my head, it's around $27,000 a year. So once you hit that maximum threshold, you cannot put more in. And then the tax-free savings account, it was, when it first started, was $5,000 a year that it gave to everyone. And then there was 1 year in the middle where they changed it to $10,000. And then now we're back down to $6,000 a year. So the beauty of the tax-free savings account is you don't need to make any income to put money into it. Whereas the RSP, you need to make income to put money into it.
Exactly.
So let's talk about two scenarios here. You have a person who's starting out, a young person makes $50,000 a year versus a person who is middle-aged and is making $150,000 a year. Obviously, they both get taxed at different rates. The person who makes $150,000 is taxed much higher. The person who's making $50,000 is basically not paying any tax. Is there a secret formula to figure out how much to put in each account? Which one's better? Yes or no?
Ooh, geez, that's tough without knowing all the details. You're working more on the client interaction side. So I would say that's something as you're speaking with the client, but as a rule of thumb, obviously the the tax savings of the registered investment plan, or the RSP, for the higher income earner is going to be a lot more powerful. So if you're taxed at a higher rate and have a higher level of income, the ability to take a portion, so 20 or 30,000, or pardon me, $20,000, and to be able to have your income reduced by that, especially if you're in a 50% tax bracket, that's very powerful. Whereas the younger person may be more inclined to look at the TFSA, especially if they aren't seeing as much taxable income in that given year. So I'm not dodging the question, but I think as a general rule of thumb, that would help delineate some of those subtle differences between the high and the low income earner.
Totally. I actually just threw that one at you as a curveball. And you answered it very well. I love it. But yeah, I mean, at the answer to that question too, like I agree with a lot of the things that you said there. And I think that the way to figure out how much you should put in either account or which one's better is really the answer that you get from the interaction with different people, like an advisor like me, and actually the creation of that financial roadmap that'll show you like, okay, you need to save this much here and this much here to optimize your taxes and also savings.
Exactly. You need to know what the goals are and where those life kind of milestones are and how the money is allocated and what it's going to be used for and when. So like you said, building the kind of a roadmap and a timeline and connecting those milestones and those life events with the people that you invest with and when that money is going to be needed and what the uses are for.
Well, yeah, totally. I completely agree. And I wanted to say thank you very much, Tyler, for coming on today and talking about these like investing 101 basics. I think, it's a refresher for some people that are on the line, and it's going to be more of a, a new thing to learn for others. And I think everyone needs to be taught all of this. So I really appreciate you taking time out of your day to teach everyone about this and introduce yourself to some of our clients on the line.
For sure. Well, appreciate the time and hope it brought some simplicity to it. Take care.
Yeah. As normal, everyone, we will be back at bi-weekly and 2 weeks from now. And also this video will be posted on YouTube once we get some approvals from our back offices and compliance teams. So without further ado, thank you very much, everyone, for joining. And if you missed the video, I'll be sending you the link. Take care.
Bye.